The Intelligent Investor, a journey from Wall Street novice to stock market sage in the bustling world of finance, where numbers reign supreme and the stock market's mood swings rival those of a temperamental toddler. Benjamin Graham stands out as the voice of reason. The Intelligent Investor isn't just a book, it's a transformational journey. With Graham as our guide, we traverse the intricate maze of investing, armed with wit, wisdom, and a sprinkle of humor. Understanding the investor versus speculator dichotomy at the heart of Graham's philosophy is a simple distinction. Are you an investor or a speculator? Now, before you start envisioning investors as bespectacled individuals poring over financial statements, and speculators as thrill-seekers skydiving off financial cliffs, let's clarify. An investor thinks long-term, seeks safety, and is content with reasonable returns. A speculator, on the other hand, is swayed by market moods, often driven by hope, fear, and sometimes sheer boredom. It's the difference between enjoying a well-cooked meal at home and gambling your dinner money on a dubious food truck that might or might not give you food poisoning. Mr. Market, your unhinged business partner. One of Graham's most colorful analogies is that of Mr. Market, a business partner whose mood swings make him both an ally and an adversary. Some days he's euphoric, quoting ridiculously high prices for your share of the business. On others, he's down in the dumps, pessimistically lowballing the value. The trick? Don't let Mr. Market dictate your decisions. Use his mood swings to your advantage. Buy when he's overly pessimistic, and consider selling when he's irrationally exuberant. And on days he's making no sense? Maybe just offer him a cup of tea and ignore his rants. The margin of safety, your financial safety net. If there's one principle Graham emphasizes repeatedly, it's the margin of safety. Think of it as a buffer, a cushion, or if you're feeling particularly poetic, a financial embrace. It's the difference between the price you pay for a stock and its intrinsic value. This margin protects you from nasty surprises, market downturns, and the occasional poor judgment, because let's face it, we all have those moments. It's like buying an umbrella in anticipation of rain. Even if the downpour is heavier than expected, you're covered. Diving into the depths of stocks and bonds. Stocks and bonds are the bread and butter of investing. But rather than viewing them as mere financial instruments, Graham encourages a deeper understanding. Stocks represent ownership in a company. When you buy a stock, you're not just purchasing a piece of paper, you're becoming a part owner of a living, breathing business. Bonds, on the other hand, are more like loans. You lend money to an entity, be it a corporation or the government, and in return, they promise to pay you interest and eventually return your principal. It's like lending money to a friend, except with legal obligations and less drama. The allure and perils of growth stocks are the rock stars of the investment world. They're flashy, popular, and promise the allure of high returns. But just like rock stars, they come with their share of volatility. Today's chart-topping sensation could be tomorrow's one-hit wonder. Graham advises caution. While growth stocks have their place in a diversified portfolio, it's essential to ensure you're not overpaying for the hype. Remember, today's can't miss opportunity could be tomorrow's wish I had missed regret. The defensive and enterprising investors. Choose your adventure. Graham introduces two primary investor archetypes, the defensive and the enterprising. The defensive investor is like the diligent student who consistently does their homework, attends classes, and gets decent grades without much fuss. They seek a stable, well-diversified portfolio that doesn't require constant attention. The enterprising investor, however, is ready to roll up their sleeves, dig deep, and put in the extra effort for potentially higher returns. They're the overachievers, the ones burning the midnight oil in search of undervalued opportunities. Both approaches have their merits, and Graham's advice is to choose a path that aligns with your temperament, skills, and commitment level. Inflation, market fluctuations, and the investor's psyche. The financial world is rife with uncertainties. Inflation erodes purchasing power, market fluctuations test our resolve, and economic cycles remind us of the ever-changing nature of finance. But Graham's message is clear: while we can't control external factors, we can master our reactions. By maintaining a long-term perspective, staying informed, and keeping our emotions in check, we can navigate the stormiest financial seas. It's not about predicting the market's every move, it's about crafting a strategy resilient enough to withstand its unpredictability. In conclusion, the timeless wisdom of Benjamin Graham as we wrap up this exploration of the intelligent investor. It's evident that Graham's wisdom transcends time. In a world of fleeting trends and short-term thinking, his emphasis on fundamentals, discipline, and ethical investing stands tall. He doesn't promise quick riches or secret formulas. Instead, he offers something far more valuable, a framework for making intelligent investment decisions that stand the test of time.